Aashish Somaiyaa is Managing Director and CEO at Motilal Oswal Asset Management Company. He's joining us right now to discuss fundamentals of the market. Aashish, thanks very much. Good morning.
Morning.
To begin with, only as an aside, you've been spending a fair bit of time on social media, in a way, fending off attacks about Motilal's performance, coverage on some certain stocks. I guess it's part of a cycle. I remember seeing this in earlier market dips as well, where you see large correction in mid caps, etc., and people go after brokers and others who owned the stocks or covered the stocks. I mean, but broadly, and I'm talking about a couple of them, 1%, PC Jewelers, etc. Just a quick word on that, Aashish, before we get on with our daily conversation on markets.
So of course, social media presents us a huge opportunity to at least communicate what we think, what our views are. And if you really ask me, I think since we have portfolios where there are pretty much more like 20 stocks in these portfolios, our portfolios are indeed widely followed. And if there are questions asked to me, I take it as a compliment, because bulk of the portfolios in the industry, each and every portfolio pretty much owns the whole market. And I don't know how can you ask someone a question on a stock which is stock number maybe 71, 81 or 91 in their portfolio. So we had a particular position, and every once in 5 years, every once in 10 years, there is something out there which clearly comes as a unexpected development. It's part for the course. I think it's part of the profession. But I think as far as performance is concerned, last year, if you really ask me, has been a bit of a challenge, and I think it's not been widely spoken about or well covered actually. 2017 was a unique year, because if you take the calendar year 2017, Nifty was up by 28-29%. I think the mid cap index was up by 48-49%, and small cap was up by something like some 57%. And then instead of calendar 2017, if you extend it by 15 days on both sides, the peak of Jan 2018 or the bottom of Demon in December 2016, then these numbers get hugely exaggerated. Now, we are stock pickers. And when the market gains this huge momentum, high beta, deep value contrarian kind of rally, then it becomes very difficult for people like us who are basically owning 15-20 stocks, bottom up, high conviction. So if you ask me, these kind of huge rallies are very difficult for stock pickers, whereas 2018 has been a different year. And while the discussion has steered in a particular direction, I mean, we never owned PC Jewelers at all in any of our portfolios, so no connection out there. But 2018 in fact has been a better year, because while the market has corrected, these are the times when we are able to recover the alpha. And hopefully our clients are looking for a return over a 3-year period, rather than worrying about one individual position or worrying about just the last 6 months or any one calendar year. So I think things are looking great from here on. These kind of markets are better for stock pickers than what we saw in 2017.
Okay. Aashish, hi. Thanks very much for joining in. It's definitely become much more difficult to pick those stocks, because you don't know whether they come with the risk of, an auditor leaving or maybe some other corporate governance issues these days. So how are you filtering your mid-cap selection now? Have you learned from the examples which have taken place in the past couple of months in mid-cap pharmaceuticals and the 1% of the world? Have you strengthened your process, or what kind of due diligence are you undertaking?
So, in terms of the process has always been out there in the open. I think we are, anybody who is in the equity markets as a professional, whether they accept it or not, the reality is that you are dealing with uncertain outcomes at all points in time. We do research, we do our homework, but generally we are dealing in a profession where the outcomes are never in our control. And whatever wealth creation efforts we make for our clients, the outcomes are over 5 years, over 7 years, over 10 years. And the proof of the pudding is only going to come much later. Hence, if you see what we have always been stressing on, in fact, we are one of the few guys who puts our investing philosophy and our style out there in the open. And I think that's why we invite a lot more attention probably. So our screeners are pretty much in place. I think we generally don't own cyclicals or commodities. We typically try to own secular companies and hold them for say 5 to 7 year kind of time frames. Our average holding period actually is more than 5 years when it comes to any of our portfolios. And the screeners are pretty much there on return on equity, secularity of earnings growth, leverage ratios, volatility of the earnings growth. So it's pretty much laid out there. Learnings are clearly there. If you really ask me, I think there are certain times when markets give you signals. There are certain times when there is certain things which you miss out, and maybe you need to clearly delve deeper. The process is all pretty much in place. Process doesn't change. I think maybe the severity of application is something which has to continuously be beefed up.
Aashish, can you talk about a specific position in some detail? I mean, just checking. If you can, then we can.
That would be a challenge for me, honestly speaking.
Okay, no problem. Fair enough. You were talking about this only trying to own secular stories. So let's talk about here and now. One big turnaround. I mean, the beginning of 2018 was IT. Then it spread to pharma. I mean, the pharmaceutical index is up 16% over the last 12-13 trading sessions. Many on the opposite side, right? Many believe that the decline is actually, I mean, the change for worse in the pharmaceutical sector is actually structural. It was not a cyclical one-time dip that we saw and things are now going to be all right. Nobody's disputing that the opportunity is there, growth is there, but it's taken a turn for the worse and for good, and it's going to stay on that road. Do you agree with that?
So, clearly, whenever something takes a big knock, for example, even some of these businesses were expected to be moated, and in the last couple of years, precisely those moats have been taking a knocking or taken a hit. So pharma is something, I mean, we typically always had, if you see our funds, while we did have some of the big generic players maybe 2-3 years back, but in recent times all our funds have had more like the domestic bottom-up Indian pharma kind of companies. Having said that, coming to your question, there is obviously been this wave of, governments trying to control healthcare costs, whether it's the US or whether it's India. And I think eventually these are things not cyclical in the sense of the word cyclical, but these are, things where even the policies, they change over a period of time. The reason is that if you don't allow pharmaceutical companies to make money, clearly it is going to impact, future investment and R&D. And it's not like these things are static in nature, that, if you come out with a particular drug and, the government allows you to earn for 2 years and then cuts your earning for the next 10 years. I mean, even the viruses and the bacteria mutate and people need to keep going, keep getting into research on an ongoing basis. So I don't think it is perpetually possible for governments to keep knocking down prices and hurt the pharmaceutical players to an extent that they don't want to really invest and the future plans get into a jeopardy. So there will obviously be, these things swing both ways. And yes, there have been pricing pressures. Yes, there have been compliance pressures. Why do you think so many of these approvals are coming thick and fast? Because obviously somewhere some views probably have changed.
Okay. All right, Aashish, a pleasure talking to you. Thanks very much for joining in and speaking with us. So that's the view coming in from Motilal AMC. Just want to point out for the Nifty 10,700.